everyone. Thanks for joining us. My name's Dave Rees. I'm the managing partner at Convergence. Thanks for taking time out to join us. I'm looking forward to hearing from our guest this morning, Jarrod Kerr. As you no doubt aware, Jarrod's the chief economist at Kiwibank, and he's the sort of guy who can help us make sense of what's been a pretty challenging last few years and shed some light on when exactly things are likely to improve. So really keen to get his view on a few different things. But just before we get into it, I can see quite a few familiar names on the call, but I'd be remiss if I didn't fill in the blanks for anyone who hasn't come across Convergence before. So I promise just a brief snapshot before we get started. So we describe ourselves as a specialist search firm. We help companies to find and select talent. It's predominantly for leadership roles, but we also do quite a number of specialist positions, and that runs a pretty broad spectrum. It's everything from exec team roles through to, for example, specialist investment team roles in funds management or compliance roles for insurance companies, for example. So we do a lot in the technology space, especially project roles and data science roles, as well as other functions, sort of more conventional stuff, sales and marketing, finance, operations. So a really broad variety. And typically, companies engage us when they want a really comprehensive market search, something that's going to unearth the best possible talent. And because each of our team are specialists in their particular function, our clients know we understand the problem they're trying to solve. We've got the networks and the resources to really extend their reach and introduce people that they simply won't see through conventional methods. So, it's a little bit about us. What we're actually here to talk about today is the New Zealand economy. I'm delighted to have Jarrod with me. We're going to dive into a few different topics. Firstly, to kind of understand the background to where the economy's at right now. I want to get Jarrod's take on how things are sitting at the moment, and crucially, his view on the year ahead, when we're likely to see a more positive environment. And then lastly, we're going to dig into more structural issues, particularly around productivity, which I think continues to be a pretty significant drag on growth. We're going to do all that in approximately 40 to 45 minutes, and then we'll move into a Q&A before we finish up. The chat function is live, so please throw your questions in there as we go. Use it as a bit of a placeholder for questions as they occur to you, and then we'll come to those at the end. But anyway, Jarrod, our last webinar, as I just reminded you earlier, was a few years ago around the time of the pandemic. We were kind of amid border closures, supply chain challenges, and I hesitate to remind everybody about that period. I think everyone's trying to sort of set it to the back of their mind. But I mean, after that, it felt like things bounced back, only to then fall off a bit of a cliff. So perhaps just to kick us off, can you sort of set the scene, give us some context for how things played out and what's brought us to where we're at right now?
Well, I don't think I need to remind anyone about just how difficult COVID was for New Zealanders and for people around the world. When we spoke, we were probably in the middle of the madness. To give you an example, I speak to the Kiwibank board probably once, twice a year to give them an update of what's going on. During the pandemic, I was meeting with the board daily. Every morning, we were giving updates as to what was going on. So it was really sort of panic stations at that point in time. And the response was, the government to do all that they can do, and the wage subsidies proved to be pretty good. And the central bank to do all that they can do. And they did a lot, actually. They didn't just cut the cash rate down to a 0.25%, but they also printed money to buy bonds. And there was a lot of things they did, give banks cheap access to credit as well. So the initial reaction was good, but we did actually end up doing too much. Central banks did too much, governments did too much globally. So we overstimulated and we sort of bounced out of COVID like a bull, in a field, and off we went. We had record low mortgage rates of 2%, even lower than what we got in the 1950s after a world war. So that really stimulated things. And just to recap, the housing market gained 45% in 18 months. Absolutely unheard of. 45% in 18 months. Inflation went to 7.3%. A lot of things just ran away from us. We had supply disruptions at the same time. We had a surge in demand, so prices went up. Central banks globally then had to reverse really quickly and hike. Some went aggressively, like the RBNZ, some not so much, like the RBA in Australia. And the Reserve Bank's heavy hand caused, quite a recession that we're still feeling today. That recession started at the end of 2022. Some of it's been revised away, but on a per capita basis, our recession started in 22 and is still with us today. The recession sort of snowballed, started, like I said, in 22, got worse in 23, and got a lot worse in 24. So the middle of last year, there was a very large contraction in economic activity. Housing market has fallen 17%, driven by Wellington. Wellington's had the largest decline in house prices, down 25%. Auckland's about 22, 23. And Christchurch is only down sort of 7 or 8%. So that really shows you, what a good balanced housing market looks like and should be, because they've built back better from the earthquake. But right here, right now, the Reserve Bank has caused, quite a disruption with their heavy-handed hikes, and now they realise, well, it's time to go the other way again. And as of August last year, they started cutting rates. So they hiked all the way from just 0.25% all the way up to 5.5%, which was quite heavy-handed, too high for too long on the hikes, and now they're having to cut quite quickly to take their foot off the brake, and we're still in the middle of those rate cuts now. So the Reserve Bank started cutting in August, and then they delivered 3 50 basis point cuts, one not that long ago, and we're expecting another 75 basis points of cuts this year, and that'll take the cash rate back to 3%, and 3% is a bit of a Goldilocks rate. So that'll be a nice kind of removal of the heavy-handedness of rate hikes.
So how would you characterise where we're at right now? Because, as you say, we're partway through an easing cycle, but there's still more to come. So how does it feel to you right now when you think about the situation that we're in?
So the recession, has really affected a lot of companies, and you have obviously seen it firsthand, but it really has affected a lot of companies in New Zealand. We've seen businesses, go from, talking about survival mode, how do I get through this current period, and, downsizing, looking to reduce hours, looking to reduce headcount, looking to do what they can to restore a bit of profitability. They are still concerned about their order book, their sales. They're concerned about the demand from their customers. That's their number one concern. Whereas you go back a couple of years, their number one concern was actually the inability to find staff, the inability to find workers. They'd gone through this period of extraordinary demand in the economy, and they couldn't keep up. And, that was only a couple of years ago. And now it's the reverse. It's like there's not enough demand. We're having to cut. We're having to right size for the situation now. So they're still, focused like this with, heads down, trying to put out fires. That'll change. Since August, that first rate cut just kind of snapped people out of it. Because, this time last year, there were some banks calling for hikes, some banks calling for cuts, economists in the middle of all of that. And that view has been kind of whittled down to, well, the cuts happen. So those calling for hikes, that was unhelpful. Cuts happens. There's more cuts to come. And, that it's gone from economists, calling for cuts or hikes, confusion, to now cuts have happened and there are more cuts coming. So you can just notice that the businesses that we speak to, their heads have lifted up a little bit and they're kind of looking around and going, okay, maybe there is some good news on the horizon. It's still 6 months plus away, but there's light at the end of the tunnel. And I speak to a lot of businesses and they come away saying, we really appreciate the optimistic view. I'm still putting out fires, but geez, I'm looking forward to that recovery that you're talking about.
Yeah, I think what our experience is exactly the same. We noticed maybe July last year, I think, in anticipation of the first cut in August, just that expectation, I think, created almost like a palpable lift in mood. People just felt that there was light at the end of the tunnel. And definitely, coming into this year, I think hiring intentions are better than they were. Still pretty low. On a sort of a if you look across the all-time index, it's pretty terrible. But as you say, it feels like there's relief coming. How does the global? When we talked a little bit about the New Zealand economy, but I'm just thinking, how does the global situation play into this? I mean, we've got. I don't want to characterize it too harshly, but I mean, there's seems like there's a lot of instability. You've got the threat of a trade war, and you've got actual war, or even the prospect of peace talks coming up. I mean, all of that creates a lot of uncertainty around. So, how do you factor that into the outlook for New Zealand?
You just hope that some of these bad things aren't going to happen, because you can't. The problem with forecasting is you have to make assumptions, like you really do. And forecasting the New Zealand economy, do we factor in a full-blown trade war driven by Trump that causes China to do some crazy things, and they're our largest trading partner. So New Zealand's greatest strength is New Zealand's greatest weakness, and our greatest strength, is our export sector and our ties to China. That's our greatest weakness. China can hurt us if they want to, right? And they're already, playing around in our waters. So they could really just turn around and say, well, we don't want your dairy anymore. We don't want your meat, your wood, your whatever, and really hurt us. And they've done that to us in the past. They've turned off the tourism tap. If you remember back in 2018, 19, I believe, and they've done it to Australia on a few occasions, right? Just, well, you don't like what we do or what we stand for, then, we'll sever ties. And that's what worries me. It really does worry me. What Trump is doing is very pro-US, not the rest of the world. He couldn't care less about New Zealand. So very pro-US. His policies are pro-growth, pro-business, and inflationary for the United States. Don't care about the rest of the world. What we're hoping is the old the saying, take Trump seriously. He will deliver tariffs. Don't take him literally, i.e., he might not deliver 25% tariffs. And we're kind of in that camp that what he delivers ultimately in the art of the deal will be tariffs more like 10%. Maybe we are a little naive, but we're kind of hoping that he delivers tariffs around 10%, because 10% doesn't matter. 10% tariff on a $10 Chinese T-shirt, who cares? And that's more a revenue grab for the US government. So 10% is more like a revenue grab. You actually generate a lot of revenue on that. But there's good treasury analysis that says, 25% tariffs and above, you don't actually collect a lot of revenue. I.e., what happens is, trade gets diverted, people substitute away from goods. So if you hear of a tariff of 25% and above, that's a serious tariff that is aimed at actually changing behavior. So the ones on that he's threatened on Canada and Mexico, they got our attention because they're quite serious. Whereas 10% here, don't worry about it. How all of that plays out, that trade stuff is going to be quite critical for us. And then if you really want to step back and think about the geopolitical risks that are out there, I've kind of touched on it already, but it obviously gets much worse when you start to think of Russia and the Middle East and Asia, our part of the world, too. Things start to get more worrisome. What we've noticed or what we've seen is globalization, which was something that was really pushed a few decades ago, has peaked. So the amount of exporting we're doing as a percentage of our activity looks like it's peaked and is coming off. And all of these Trump-style policies, which are pro, US, pro, that country, that's the unwind. That's deglobalization. And there's a lot of reasons why you would do that. COVID really exposed supply chains. So you want to get a better grip on your own supply chain, and having it in your own country where you can is, obviously a safer bet for occasions like for problems, pandemics, whatever we get. So there's a good economic reason for thinking about that. But then there's the probably the real reason, which is the US would be looking at its supply chain and thinking there's a lot that comes out of China. We might be going to war with them later on. So it's not that good that maybe your ammunition's made in China. Maybe your soldiers' boots are made in China. So I think there is actually a behind the scenes, let's do more of this stuff ourselves. Taiwan is the greatest exporter of semiconductors, chips. They could be annexed by China. There's just a lot of geopolitical fragmentation out there that really scares me, to be honest, if it plays out in the wrong way.
Yeah, I mean, from a business planning perspective, is it just too hard to attach probabilities to these things? If you kind of be aware of the risks, but not really, if in terms of converting the awareness of the risks into an action plan, is that just there's just too much uncertainty and the probabilities are just too hard to nail? No,
I think you have to do it. We do it as a bank. I've done it in all the banks that I've worked for. We run scenario analysis. So you'll have your economist turn up and say, this is our central view, and the central view for New Zealand is good right now. I think things turn around in the second half of the year. Next year is going to be better. How good? Okay, so that's your central scenario. What's the upside risks? Probably not a lot, actually. There are upside. Things could get better faster. We might get a little bit more inflation. That's your upside risk. There's not I wouldn't put a massive amount of weight on that. What are your downside risks? Plural. Well, there's quite a few. And I would put uncomfortable weightings on those. So what does that mean? Well, you position yourself for that central scenario that things get better, but then you must have an eye on things getting worse. And what are some of the triggers that you can see? What are some of the things you can look out for? And we develop a dashboard, if you like a heat map. If we see such and such happening, then that'll flash red. If we see something else happening which is good, that'll flash green. And you kind of look around, and you could imagine as in the middle of COVID, it was just a sea of flashing bright red, whereas now it's kind of, a lot of amber, some green spots, some sort of amber spots. So you do have to try and think your way through what happens in a trade war. What happens if we close our borders down, but this time it's more for a war-like scenario rather than a COVID scenario. Believe it or not, in COVID, when you look back in history, the only other times we've kind of closed our borders like that is during war.
Yeah, for sure. Let's all keep our fingers crossed that
doesn't happen.
But I guess it's interesting what you said about the triggers, because for businesses planning, supply chain, for example, that whole reshoring thing is hugely expensive. So you don't want to do that unless you're pretty confident that you absolutely have to. So in terms of that triggers and that heat map, is that something that's available to small and medium-sized businesses? I get the kind of corporates that may have their own economists on staff sort of running these different scenarios, but for mid-tier businesses, how should they think about that, or what access can they get to those sort of tools?
It's a good question. I've never thought about it. So obviously, what we do is all internal, and a lot of it's our own indicators as well. What we're seeing in the system. That's a lot of it's off our own data, but some of it you can get out there. Some of these leading indicators can be quite useful. Even just simple things like the Kiwi dollar. You say, well, what do you mean the Kiwi dollar? Well, the Kiwi dollar is actually traded as a risk proxy for Asia and as a commodity currency. So if things get bad, the first thing that moves, believe it or not, is the Kiwi dollar. So the Kiwi dollar is one of the key things I like to look at on any given day. Same as the Australian dollar; it's exactly the same. If things go sour, our currencies are tumbling, and that tells you straight away something's wrong, or people are positioning for something to go wrong. And generally, you get that positioning, before. And then when things go wrong, the Kiwi is just, absolutely hammered. So, as a simplistic thing, I think the Kiwi is probably one of the best. And then I also like looking at some of the higher frequency data that I can get my hands on. But yeah, financial markets tell you pretty much everything you need to know in real time.
You mentioned some of those high frequency sort of data sets that come out. What sort of thing do you tend to look at, and other people might be able to grab onto, and just to sort of build a bit of a set of these triggers?
There's some good stats that have become available recently that are of a higher frequency around the labor market. So there's some good stats on job ads and that sort of stuff, which is a little bit more real time. So that's kind of helpful. The stats department has sped up a few things, and it's the monthly stuff. It's the the weekly stuff that you can get a hand on. That is quite helpful.
Yeah, I think StatsNZ do a sort of a composite of Trade Me Jobs, Seek Jobs, and a couple of others, and BNZ do a series with Seek specifically, looking at job listings and application numbers, which is pretty useful.
Yeah, it gives you a pretty good now. Yeah.
Yeah, I think there's the StatsNZ one is monthly, isn't it? So it's pretty good.
Yeah.
Although there's a bit of noise in that, obviously.
Yeah.
What about your outlook? I guess that's kind of where the rubber hits the road. Is what is your forecast? What is your sense of how the economy is going to track in various different aspects, right? Like what are we looking at from a growth point of view? We're looking at fiscally. What do you think rates are going to do? Can you just sort of walk us through in detail what your outlook is for the next sort of 12 months or so?
So just all that we've sort of said so far, putting all that together, the most important thing is, well, what's the central bank doing? I guess we know what the economy's done, and that's not good. But what is the Reserve Bank doing to turn that around? And they're cutting, and they've cut aggressively, and the rate cuts in August are still feeding through. So only about 9-10% of mortgage holders are on floating rates floating rates are too high, to be honest, but they're on floating rates, and that's generally just because they're drawing down on a loan. So there's not many people on floating. Say 90% of people are on a fixed rate. What's changed is that people have actually shortened up their rates. So before 2008, in sort of 2007, about 60% of the mortgage book was fixed for sort of 18 months and longer. So when the financial crisis hit, the Reserve Bank was slashing hard to try and provide relief to households that they're on a 2-year fixed rate. So it was really frustrating, cutting all the way from 8.25 down to 2.5. Now that's a big move, massive move. They did 100, 150, really big moves. And then, you're waiting for the mortgage book to roll off. Really frustrating. Now, actually, most people have been listening to economists like myself who've been calling for rate cuts for a while, and they've gone, you know what, if he's right, I don't want to be on a 2-year rate. I want to be on a 6-month rate. So 81% of the mortgage book now is fixed for less than a year. I think 50 plus percent is fixed for less than 6 months. So cutting in August, feeding through now. And that's rapid for New Zealand, right? Those cuts are still coming through. They should be finished by around the middle of this year, or maybe as late as August, but around the middle of this year. So people will the whole mortgage book will pretty much roll off, apart from a few percent. And that's why we're picking, growth to lift in the second half of this year. Maybe it lifts a little earlier, maybe it lifts a little later, but I think we're reasonably confident on the trajectory, which is one of improvement later this year. So what have we got for growth this year? About 1%. Not a lot, and most of that is back in the back end of this year. What have we got for next year? We got 3, and that's good. That's a good result. 3% would be happy with that. So that's the trajectory. But as you say, what are the risks? Well, there's downside risks and there's less upside risks. So hopefully we're right in our central view.
Yeah, absolutely. I know you've got a few slides there that you wanted to share as well. You wouldn't be an economist if you didn't lean on a few charts. Do you want to throw those in?
Yeah, absolutely. So what I like looking at, going back to your point before, probably not easily accessible, but you can get hold of them, are these global PMIs, Purchasing Managers Index. They give you a good handle on what's happening, but if you look within them, there's something called new orders. So this is the new business that they get. That's a good forward-looking indicator. These PMIs, they actually lead stock markets. So when you see a PMI going up and down, that then feeds into expectations in equity markets. So anyone like trading stocks or has got a Sharesies account, that gives you a bit of an idea. My personal favorite is the Dallas Fed Real Economic Activity Indicator. Basically, it's just shipping prices. What worries me is that it was looking okay last year, but just in the last few months, it's popped into negative, although the PMIs have stayed in positive. So a little bit of a mixed message there, but I do hope that switches around this year. Inflation's a big one, just because central banks have had to tackle that problem. That problem's gone away. Inflation's not a problem at the moment. So that then unlocks central banks to cut. And we've seen central banks cutting, even the RBA cut. They've done less both ways. Like you said, I wouldn't get very far unless I mentioned one of the big concerns for households. So households have been hit. We talked about businesses being hit. and businesses have been hit because the demand for their product or service has come down. So what are we really talking about? Well, households. What are they? What's happening with households? Households have been hit not only by a massive increase in interest rates, so going from 2% mortgage rate to 7% mortgage rate, and then hopefully rolling off pretty quickly to a 5% mortgage rate. So that's hurt. But the cost of living crisis is something that we've all heard a lot about in recent years, and that's basically inflation running above your income growth. So your wages just haven't kept up with inflation, and Dave, you'd know that better than anyone as well. That has officially come to an end because inflation has actually dropped below wages. Prices are still high, but that they're not going up anywhere near as much as what they did over that sort of 2021, 22 period. That's good news. Like, you won't feel it now. You need to have a couple of pay rises that are at or above inflation to start feeling a little bit better about life. But the good news is that this has happened. Inflation has fallen back below incomes, and that should get Kiwis fired up a little bit more. This is the bit that I was talking about with regards to the mortgage market. It's such an important part of the Kiwi economy. You can see that the number of people on fixed rates for less than a year is over 80%. And the only time we've seen it that high is actually after the 2008 financial crisis, where we kind of rolled into shorter rates over 2010, 2012. And so we've kind of learned the hard way over that sort of 2007, 2008 period. We are expecting
that just allows these OCR changes to feed through to the economy faster.
So much faster. Yeah, I mean, I don't know where you were in 2008, but I was in the middle of a bank, and that was a horrendous, quite long period of pain, and the frustrations that the Reserve Bank had were very clear. And that was a big part of the problem, was that people were sitting on fixed rates for like 18, 24 months sort of thing. The RBA didn't have as much of a problem because most people are on floating rates over there, so things fed through within days in Australia, whereas it took way too long here. And that mortgage rate curve just sort of shows you the low that we had, but also the pre-GFC high, and what we've seen over the last few years. So we're pretty much in, going back to a more normal level of interest rates, a more neutral level of interest rates. We're expecting more defaults. So, you mentioned, we talked before about, what an economist does. We forecast the unemployment rate, basically, is the big thing that the bank looks at, because an unemployment rate, everything sort of flushes out into the unemployment rate. If things are good, unemployment's falling. If things are bad, unemployment's rising. For anyone who's suffered their way through an economist or an economics course, you would have heard of a Bill Phillips curve, and that's the relationship between unemployment and inflation, and we're forecasting unemployment to keep rising. So what does the bank do? We put money aside for an increase in defaults. I hate to say it, but when people lose their jobs, some of them default. So we have seen a lift in defaults. We're expecting a bit more, but not to concerning levels.
Where do you see it peaking? I've heard sort of people say 5.5%. I think it's at 5.1 at the moment. Where do you see it sort of capping out?
Yeah, not much higher than where we are. You can see on this chart here that most of the move has happened. We've been forecasting 5.3, 5.4, something like that. You can call it 5.5. You know, the move from 3.2 into the low to mid fives has been the big call from us, and most of that's happened. You know, the recession has caused a big drop in hours, but also a drop in headcount. So we think most of the move has happened. There's a little bit more to come through, as the the labour market data sort of lags the economic indicators elsewhere, and then things
like there's
head
it still
south.
feels like there's a lot of restructures going on, and companies still seem to be very challenged in that respect. You know, cost pressure, budgets being cut, that sort of thing.
Yeah, and that I think that lasts for a little while more. I think a lot of companies are still looking at themselves, even if they are more confident in the outlook to next year. You know, they're taking the opportunity to say, well, you know, we could probably right size. You know, we could cut this, could cut that. You know, it's one of those processes that many of them are going through. The other thing which I think is important to keep an eye on is migration. We've had these massive migration booms. We had one in sort of 2001, 2002. We saw from that migration boom that it led to a lift in house prices because we just didn't keep up with the population growth. We certainly didn't invest in the infrastructure required for that lift in population back then. And then we had the mother of all booms from 2013 to 19, largest migration boom we've ever seen. Didn't keep up with the housing, so the shortage got worse. Definitely didn't keep up with the infrastructure required for that surge in population. And that also extends out to education, health, you know, all of it really. We just didn't keep up for the population. We then had this interesting experiment called COVID. COVID was interesting from an economist's perspective afterwards, you know, looking back, going, that actually gave us a really interesting insight as to what happens when things reverse. So, migrants definitely kept downward pressure on wages. As they come here, they accept whatever the pay is, do the job. They probably feel like they're getting paid a lot more than where they've come from, particularly if they've come from China, India, or Philippines or somewhere. You take those migrants away, and over that period, there was a massive shortage of workers. And in order to get workers, Kiwi workers, to do those jobs that migrants were doing, like picking fruit, for example, you had to pay a lot more. Kiwis just simply wouldn't do it for the price of what migrants were doing it. So it became quite inflationary for wages. Then we had the borders reopen, and the people that would have come over that COVID period basically came flooding in 2023, and we saw this massive spike again. Again, we haven't kept up with the supply of housing. Again, we haven't kept up with the infrastructure required. All of that's now sort of unwinding. Migration is returning to much lower levels, and it's putting less pressure on the economy. And hopefully it sort of flattens off from here, but we really need to keep an eye on that. The one lesson that we refuse to learn with each migration boom is that we need to be more elastic. We need to be more responsive in our supply. You allow thousands of people in, you're going to need to build, hundreds, thousands of homes, and we're not doing it, and we're not keeping up the infrastructure. And that's one thing that we just can't get right in this country.
Yeah, I mean, interesting to understand your perspective on the sort of the fiscal position as well. We talk about whether it's building houses or government spending. I mean, there's a fiscal deficit of, I think, 2.1% in the year ended June 24, forecast to rise to 3% in fiscal 25. I think from what they're forecasting, there's no return to surplus until 2029, by which time we'll have had a deficit for 9 years in a row. How do you see that sort of playing out in terms of its effect on the economy? Not to mention crown debt as well being a bit of an impediment.
Yeah, I think this government, like all governments, have got some serious challenges. It's really difficult to do what you want to do when the economy's in recession. Really hard, right? Not only do you have to cut spending, you've got to really think about where you allocate your spending, right? It becomes so much harder to deliver what you want to do. And we've been through a really bad recession. So their starting point's really, really difficult. I do like the mantra around go for growth, and Nicola Willis being this growth person. I do think that's what we need. We need to go for growth, but we've got to have the infrastructure behind it. And governments, and I say governments plural, have underinvested in infrastructure for decades. So we're getting some good noises out of the government as to how they want to tackle the infrastructure deficit, but it's really hard in a 3-year term. It's really hard. So that we'll get some positive shifts. I hope, but we're not going to get a silver bullet that cures all here. Am I worried about deficits and debt? Not at the sovereign level, not at the government level, not at all. Our level of debt, people would love to have our level of debt. Countries around the world, United States over 100%. Australia, very, very super strong. I think they're 10%, worse than us. AAA rated nation, hardcore. You put Australia at the top of your list, sort of thing, and we're right up there with them as one of the most highly rated sovereigns on the planet. There's only 10, I think, or 11 sovereigns as well regarded as us in Australia and Canada. Luxembourg, they're in there. Singapore, they're in there. Some other countries that you can't find on a map, they're in there. United States, nope, downgraded in 2012. UK, definitely not. They got a double notch downgrade after Brexit. You start sort of looking around, where are these AAAs? Well, there's not many.
Well, there was concern about a downgrade here, wasn't there? Is that kind of abated now?
Yeah. I mean, there's a risk, right? We are running a deficit for a long time, and we are lifting our debt. But in my discussions with S&P, at least, we've still got ample room before they would even consider a negative watch type, downgrade. I don't think it's on the agenda yet. Sure, they fire some warning signals, as they do to all governments that are running deficits. If this continues, then we're going to have to look at you guys, sort of thing. They give us that warning, but I don't see it happening. Even if it did, I wouldn't worry, because what we get downgraded to the United States level, what we get a double notch downgrade, and we're still above the UK. You know what I mean? We're so high. Yeah. I would actually, I would go as far to say as we've got the ability to really increase our debt and address the infrastructure deficit, right? I would rather get a downgrade and, spend $100 billion on fixing the economy, because I know one of your next questions is going to be around productivity. And I think that's probably the piece that's really embarrassing for New Zealand. That's a real stain on our economy, has been this lack of infrastructure investment. The burst pipes in Wellington, the 40-minute drive time to go 10 kilometers in Auckland. You know, all this stuff is just inexcusable.
Yeah, yeah, absolutely. I mean, for all that, from what I understand, annual GDP growth in New Zealand has often been above the OECD average. But from what I understand, that's largely because of labour inputs, right? We're working longer hours.
Yeah.
We've got inward migration, increases in labour participation. So aside from that, there's actually some really concerning trends there. And I know productivity is something you're sort of keen to touch on. So why is it so? Just maybe kick. Why is it so important to increase that that productivity rate?
Oh, look, that's the holy grail from an economist's point of view. Like you want to be able to produce more value with fewer inputs, right? I mean, every company on this call is trying to do this in their day-to-day work, right? And we need to do more of it across the entire economy. So, you know, at a business level, you know, getting rid of the paper receipts and invoices and moving to Xero or some online thing, you know, there's a boost in productivity. I talk to accountants all the time, and all of these developments have enabled them to spend more time on the client. So they may have, you know, put 20 hours into a client, and 10 to 15 hours were, you know, following up on receipts and trying to get paperwork. Now all of that is so much easier. They're spending 15, 17 hours on actually providing, you know, quality advice and actually really analyzing the business. So that's a big productivity boost, and that's technology. As a country, we don't embrace technology as well as we think we do, particularly compared to other countries. And we are at the start of what is going to be the most incredible, you know, technological advancements in human history, and that's AI. And we don't even know what AI, you know, can do. We've got ideas of what it can do, and just the ideas themselves are incredible and could be amazing for productivity. So technology is a big part of that, kind of an easy one to explain. Some of the other ones, you know, education, health, these things are also very important for you know, more productivity. You got a healthy worker, they work longer and they're not taking sick days. You got better educated worker, well, you know, obviously fantastic for the business. But the one piece that really I think has restrained us has been that infrastructure underinvestment. Had we kept up, had we had a bit more foresight, more vision as to how large New Zealand is going to be, we would have built a lot more along the way, and we wouldn't have created all these bottlenecks that I do believe are suffocating our economic potential.
Yeah, yeah, totally. I mean, when you think about health or education or infrastructure, those are all things that are set at a policy level.
Yeah.
What can companies or individuals do? I mean, you mentioned technology adoption. There's also, you know, management capability, which is one that's often a driver of productivity growth. But what are some other stuff that, you know, we could be thinking about as individuals or as companies to help drive productivity improvement?
Oh, you know what? I think that's one that I would ask you, to be fair, because you know, there is a lot that businesses can do. You know, getting a consultant in, or just getting an accountant to, or someone with you know, a knowledge of your industry, or you know what your business is doing, and the competitive forces that you face, and what are the risks to your businesses. You know, getting someone in and just to have a look, around, saying, oh, you know what, you could do this better. You know, at bank level, you know, we're quite large businesses, so you know, we are able to hire quite expensive consultants to come in and go through the entire bank, and you know, they do pick things apart. You know, you've got too many people here because these people over here are doing the same job. Like, why are you doing it twice? Or that process, you're taking a mortgage application and you're printing it out, for God's sake. Well, what are you doing? So there's a lot of those sort of things. You just need a impartial, or just another lens, someone just to come in and go, you know what, I've worked with these businesses over here and this is how they do it. Maybe you could do some of those things.
Yeah.
But what do you recommend? I mean, your area is right in the thick of it on the personnel side.
Yeah, I think in general, I mean, there is a structural issue just in terms of, look at the distribution of sort of companies through the economy. There's the very thin layer of sort of top tier corporates that have got that true scale. So I think the scale challenge is a problem for most companies. But there's one that could be solved, at least in part, by having a greater degree of sort of leadership courage, if I can put it like that. A greater level of risk tolerance and looking to embrace innovation and demanding higher performance levels. I mean, we all love New Zealand for the lifestyle, but actually, when you look at the hours worked, it's actually a little bit of an anomaly, right? It kind of contradicts the lifestyle option. So improving productivity works for everybody, but I think there's just a lack of consciousness of it, and people that are conscious are perhaps a little bit sort of fearful, or perhaps just don't have the tools to embrace it. It's been interesting to see the trend, or the reverse of the work from home trend. Companies often talk about improvement in culture and connectivity, and I think that's all very valid. But in discussion with people, there's a serious productivity objective there as well. So I think that's something that can help. But as you said earlier, AI or automation, I think these things there's a level playing field now, and perhaps in a way that there wasn't 30, 40 years ago. We're as capable of adopting these solutions as anybody. So I think it's just upskilling ourselves and just taking the time to embrace these things.
Yeah, completely agree. And on your last point there, one of the greatest excuses New Zealand's had historically is that we're at the edge of the earth. We're right at the edge of the earth. That we're over here, the earth's flat, everything's happening over here. And that has been, the tyranny of distance, as the Australians call it. We've just been so far away from the center of the economic universe, which, used to be in Europe, right? But there's two things that have happened. First thing is that the center of the economic world has actually moved more into Asia with the rise of China. So we've actually become geographically closer to the economic action, thanks to the rise of China. But don't forget about India, because they're the next one. And so that's less of an excuse. And of course, in the modern world, it's not that hard to ship anything. So if there's some brilliant new machine created and built in Germany, and it's like this big shiny machine that makes things so much faster, maybe we wouldn't have got access to that a long time ago. Or maybe it was, took a lot of time. Whereas now, get it on the next ship, please, absolutely. And it's here in a few weeks. And your point on software and that sort of stuff, well, there's no impediment there.
Yeah, absolutely. I'm conscious we've got a bunch of questions here, and we're kind of running short of time. So let's just dive into some of those, and just keen to get your thoughts. So first one, if we were to strengthen the New Zealand economy and encourage overall growth, which sector and where would you incentivize?
I would be quite open. I would be very open in this new world. I wouldn't say, oh, I'm going to focus on dairy farmers, or I'm going to focus on Rocket Lab, or I'm going to focus on accountants. I would be quite open. I do think we go through these periods where we discount the agriculture sector and the primary sector. I remember at the end of the 1990s, we were talking about this wave of technology that was going to hit. There was a tech bubble, percolating, and it ultimately burst, but we're still benefiting from it because all the Googles and these companies came out of it. But I remember very clearly at the time going to a few conferences where most of the academics were saying, we've got to cut back on dairy. We don't need to focus on farming or any of our agriculture. We need to focus purely on technology. We need to be, a Google type country. Well, that proves to be exact wrong thing to focus on, because we had this commodity super cycle, and here we are, and our farmers are doing incredibly well, and our growers. So I always consider that to be almost like the backbone, or one of those big pillars of the Kiwi economy. Manufacturing, again, where we can and where we have an advantage. I think you've got to keep that in mind. New Zealand's the most beautiful country in the world. No arguments there. So tourism, again, an industry that we could do a lot better. Maybe a higher quality experience. More money for fewer tourists, that sort of thing. There's a lot to work on in New Zealand, and we've got some really cool industries, movies and all that sort of stuff. I don't know what the next big thing is going to be, but being open to it, setting the groundwork for an ability to do more. And I think access to money, access to capital is a key part of that too.
Yeah, absolutely. Apparently, Natasha says Ukraine and the US have just agreed terms on a minerals deal. What does that mean for global markets? I wasn't aware that deal had been struck, but so that's interesting. But if you had to sort of point to some ramifications of that, what would be your sort of top picks?
Oh, look, anything that calms down that situation, hopefully they can come to some sort of agreement where that ends, will be a good thing. It will be good for Europe for that to happen. I think there's some big picture issues over the more medium term, but anything that brings an end to that horrible war would be absolutely delightful, and the markets would just love it, because they would then turn around and say, well, geez, if they've managed to come up with a deal here, maybe there are a whole lot of deals to be struck elsewhere that doesn't cause an escalation in either a trade war or an actual war.
Yeah, absolutely. I'm conscious we're kind of approaching 11 o'clock, but I mean, if you're happy to keep going for a little longer, I don't know how you fixed the time, but there's plenty of questions here. We've still got, well over 100 people on the call. So, I think people are enjoying this. Economist Gary Stevenson says that the wide gap between rich and poor is causing this recession. And he says it's going to get worse in the US and the UK until there is more equality and fair taxation of the uber wealthy. Nothing's going to change.
I think there's some fair points in there. One thing that is unfortunate with recessions and COVID and global financial market crisis, each of these have a really bad impact on inequality. So during recessions, obviously, but the poorer people, lower income people get hit harder than the higher income, and then you're talking about the uber wealthy, billionaires being sort of out of touch and out of reach on a tax perspective. So, I think there are some fair points, some very fair points in there, and it's something that has caused a lot of our problems. And I don't know, I haven't read what you're talking about, but, I hate to say it, but draw a chart of unemployment, draw a chart of the Nazi vote, and you get an idea as to how radicalized people can get when they're in pain and when they're suffering. People vote for more extreme. The middle's not working for you because you've lost your job, right? Or you haven't had a pay rise in 5 years. So this widening in inequality, as you rightly point out, has caused more polarized voting and more radical voting. So, things aren't working for me, in New Zealand. I'm not going to vote Labour. I'm not going to vote National. I'm going out to ACT, or I'm going Green, or I'm going Top, or whatever else you want to vote for. When people are in pain, they don't vote for the middle. They vote for some loud person on the side who says they're going to make real change. And that is, why we have seen in the 30s, the Great Depression, we saw a rise in what we call populism, and over recent, the last decade or so, we've seen the same sort of rise in populism. And the greatest example of that is Donald Trump.
Yeah, it's been sweeping Europe. You saw the German elections at the weekend, AfD getting 20% of the vote, which is, depending on your political leanings, a scary thing. Looking at migration further, there's been a lot of publicity about New Zealanders moving overseas. Is there any way to know if the people coming into the country have the same or better skills as those leaving? Just off the top of my head, what I would say, I don't know that there is a way of knowing that, but from what I understand, the people coming into New Zealand are, I think, about 80% in the low or medium skilled category. I think it's as high as that, but I don't know if there's a way to understand what the outgoing effect is in terms of sort of caliber or quality.
Yeah. So what we know on the people coming in, we have, like you say, some of those lower skill jobs, like food trades workers has been the top. If you look at this, can you see that chart?
Yep.
The top one there's food trade workers. So that's been good. Construction and mining laborers, that's good. Bricklayers, that's good. Teachers, fantastic. Engineers, I'd love a lot more of them. I'd love them employed in infrastructure. And then nurses, fantastic. Hospitality workers, love it. Farm and forestry workers, fantastic. Salespeople, don't need them. Seriously, don't. My God. And the last one, business analysts and economists, you definitely don't need them. But the first lot were pretty good that we've imported what we've been asking for in the economy, if you think a couple of years ago. But what, who are we losing? Well, we're losing the Jarrod Kerr of 20 odd years ago. People finish school, finish university, and off you go. That has increased a lot. Where are they going? Most of them go to Australia. Why are they going to Australia? More employment opportunities, higher pay, and you can drive around in Australia and not be in a traffic jam. And believe it or not, when you walk down the main street in Sydney, there's no bursting pipes either.
Yeah, for sure. I mean, we only see as in Convergence a sort of a thin slice of the overall jobs that are recruited in the economy, or people that are coming and going. But I definitely see of the sort of professional roles and senior leadership roles, there's definitely a net loss. I'd say, in terms of quality and caliber people that are heading off. Have you got time for a couple more? Yeah, cool. 6 months rates are retailing at around 5.8%, while 1 and 2 years are as low as 5%. Is this a case of banks trying to lock renewals in now for the 5% offered, while they expect rates to fall even further below this point, i.e. shepherding renewals into a space where they're going to benefit less from future OCR cuts? What do we expect the 6 month rate to be after August's OCR review?
Right. So basically, my view is that interest rates keep falling. The market has a lot of that rate cut factored into it already. So mortgage rates, if you remember, were falling before the Reserve Bank cut. And even recently, they've been falling before the Reserve Bank cut in anticipation, just as a bit of competition within the banks, really just trying to get those lower rates in faster and ahead of the Reserve Bank, because we were comfortable that the Reserve Bank told us they're going to cut. So we started factoring those in a little earlier. So you have seen some of those moves come through already, but there's more to come. I can't speculate on where a 6 month rate or one year rate's going to be exactly, because what people don't realize is that when we're cutting a mortgage rate, we're also cutting a term deposit rate and hoping for a lower wholesale rate elsewhere. So it does depend on, you know, our ability to cut those rates as well. But if we're calling for another 75 basis points of rate cuts, well, obviously you'll get that on the variable floating rate, and the variable floating rate is high, but then you've got a 1 year rate. The 6 month rate's basically just in between those two. So as that variable rate comes down, I do expect the 6 month, 1 year, and the 2 year to a lesser extent to keep falling. And I would expect, you know, a lot more rates in the high fours, not low fives. And then of course there's the risk that things don't go according to plan, and the Reserve Bank actually has to stimulate. So the Reserve Bank's telling us they're taking interest rates back to a neutral level where it no longer hurts, but it's not stimulatory. If things go wrong, or even if the recession that we've had demands stimulus, which I can easily argue that, then there's a chance they go below 3, in which case I would think mortgage rates would be in the high fours, maybe mid fours, and depending on how bad things get, maybe low fours or threes. You know, you just don't know how bad things could get. But that's the balance of risks from my perspective.
That's good to know. Yeah, that's really useful, and certainly an improvement from where we've been.
Well, yeah, we're coming off 7% plus rates, right? So that's quite helpful for a household, that 200 plus percent, not percent, percentage point.
Basis point. Yeah.
Yeah.
When will the contractor market improve? I think. I mean, I'm not across contractors in trade so much, but I'd say in terms of corporates, contractors is largely driven out of projects, which is largely driven out of confidence to initiate projects. I definitely think that's coming back. Seen an uptick in employment indications at the back end of last year. I think that's sort of still feeding through in this year as well. But I think we're a few months away. I'd like to think, speculatively, but I'd like to think around mid-year we'd start to see things pick up significantly. I think they already are picking up a little bit, but hopefully significantly. Jarrod, you got a take on that?
Yeah, I would agree. Yeah.
Oh, right. With aging populations, and specifically in New Zealand, what are your thoughts of the need versus appetite of increasing compulsory super contributions and then raising the age of accessing it?
Oh yeah, I think that's a discussion that has to be had. I do believe that super should be compulsory, and we should be making higher contributions. So I left New Zealand in 2002, and I got a job in Australia, and they said, "Oh, here's your pay," and I'm like, "Oh, that's nice. Yeah, I agree to that." And then as I was signing, it said, "Oh, by the way, you know, I can't remember what it was back then, 7, 8, 9% of this goes into super above what you're getting paid." So there was no discussion around super. It was like, here's your pay, it's 100,000, and you agree to that. And then afterwards, I'm like, oh my God, there's like another 9% that goes into a. How cool is that? I didn't have to make a decision, and the company put it into their preferred, holder. Fine, done and dusted. 20 years of working in Australia. Yeah, it's meaningful, and they don't muck around. It's gone from 9% to 10% to 12% contribution, compulsory. I agree with that, just because, I look at my Australian super and I go, thank God for that. Like, I wouldn't have saved that. And it's great to have, particularly with an aging population, as you mentioned. The aging population thing is a big deal for all countries. New Zealand's not immune. We've got slightly better demographics than many because we import a lot of people who are young and aged between 20 and 40, and high participants, so that's kind of helpful. But the percentage of government spending into into health and pensions is it's a 45-degree angle, right? And you ask any politician, they don't want to touch it because it's potentially, you get elected out pretty much straight away when you start talking about lifting the retirement age.
Yeah,
right?
they just want to kick the can down the road.
Yeah. So unfortunately, you don't have the political will to deal with that problem. And understandably, as soon as you stand up and say we're going to, increase your contributions, we're going to increase the tax, around certain things, and we're going to increase the retirement age, could you imagine what the press would say the next day, even though that's precisely what needs to happen?
Yeah, absolutely. And then, I mean, in the States, it's become an existential threat in some ways, right? Isn't entitlements just so significant? Right, last one, and we'll appreciate your generosity here in terms of your time, Jarrod. Don't you think that tools like AI, etc., will only slightly increase productivity? The real game changer is for Kiwis to be more exposed to how things are done elsewhere. Discuss.
Sorry, say that again.
So the point is that AI tools will only slightly increase productivity, and that perhaps that grand claim that it's going to revolutionise things is overplayed. And actually, the real game changer is for Kiwis to be more exposed to how things are done elsewhere.
Oh, I kind of disagree with that. I think the technology advancements that we are seeing are incredible, and that we know are in the pipeline are game changing. Like we will have a driverless society. We know that. It's just a matter of how quickly we can adopt that. So, driverless cars, there's no longer a problem with Auckland traffic. Driverless trucks, they're already driverless in the mines in Australia. So, yeah, driverless trucks, fantastic. They're safer. They're more efficient. Rio put driverless trucks into one of its mines and had a 12% increase in productivity day one.
Yeah.
And that's just because the trucks didn't have to stop to change drivers. Driverless, everything, airplanes, the likes, that's the easy one. And that solves a lot of our, Auckland's and New Zealand's problems pretty much straight off the bat. And, the ability to monitor someone's health through a watch or something else, and it's just I don't think it's overblown. I think we're only limited by our imaginations on what technology we have today and what we're going to have in 10 years' time can do. So I would be saying we better adapt. We better make sure that the technology that comes through enhances us rather than replaces us. So, yeah, I disagree. I actually think the technology that we're seeing coming through is mind-blowing, and it will be a massive boost to productivity. But yeah, of course, Kiwis need to focus on themselves as well.
Yeah, and in terms of Kiwis getting exposed to how things are done elsewhere, there's a definite opportunity to improve that managerial competence as a driver of productivity. That comes through pretty firmly in the stats. As far as AI is concerned, I mean, it's very much a double-edged sword. I think I heard on the news last night, DBS Bank in Singapore are cutting something like 4,000 jobs purely down to the efficiency gain from AI. They've had AI in for close on 10 years. They've got a multiplicity of models that are distributed through the bank, and they're able to get a lot of gains from it. So there's productivity on the one hand, and job losses on the other. So it's a bitter pill to swallow in some respects.
Yeah, I'm sorry. I do have an 11:30, which is
no worries. You've been very generous with your time, as I mentioned. It's been fantastic to get kind of a tour through how you're seeing things from sort of A to Z. So really appreciate your time. We'll finish up there, but thank you everybody for joining. We will put the recording out and up on YouTube next week and send you all an alert on that. So if you want to go over it again, then you can do so at your leisure. But anyway, thanks, Jarrod. Really appreciate your time. And thanks, everybody who came along. Enjoy the rest of your week.
Thank you all for dialing in.
Cheers.
And thanks for having me back.
Cheers. Bye-bye.